All right, so we don't get these very often, but today we got a day where we close the week and the month at the same time. So the end of July brings us some interesting patterns on the charts, including an overbought cluster on the S&P 500. So I'm going to break that down and see what that means, how bullish or bearish that is, what we can expect out of it. Overbought clusters can be one or the other. So which one is this one? I'm going to break that down. We also got some clusters on some other important charts I wanted to show you, and the ramifications that might have from an intermarket standpoint on our risk appetite expectations going forward. So I'm going to break that down as well. And we're going to take a look at a stock that may be showing some reversal signs itself in a sector that's at times one of our best sectors, at times not one of our best sectors. And we might be rotating to one of those latter periods right now. We'll talk about how to trade that in a strong bullish market as we have been in. So let's go ahead and get started. Today is Friday, July the 31st, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, and look at here what we got. We got an overbought cluster well into this intermediate run. It's one thing to get an overbought cluster, say like right here, which is actually very bullish when you get them that early in an intermediate run, but to get them when you are now going on 4 months, or over 3.5 months of an intermediate run, that's when you start to concern a little bit. Now, you notice we were over here, back here in about mid-October. By the time you got past 2.5 months, we were getting clusters in this area. So, it's not necessarily, it doesn't necessarily mean we have to drop immediately tomorrow. But it is a sign that, boy, any upside we have right now in the intermediate term is going to be more limited. Now, granted, that's not anything new, right? I mean, we've had a 40-some-odd% return coming off that low point. It's going to be hard to get good moves to the upside from here going forward, from today going forward, without any kind of exhale at all. So, I mean, that's not news, hardly at all. And we actually avoided getting the market sentiment line included. See, the market sentiment line is actually coming down. We got up to what did we get up to? 79.61 was the highest the market sentiment line got to here. In the last couple of days, it's actually pulled down to just below 79. So I mean, that's how close we are to getting a cluster on all 4 lines on the S&P. So it's obviously we're overbought. That's nothing new. It doesn't mean we have to sell off. It just means that if you're entering some new directional trades to the upside right now, keep in mind what your reward to risk ratio is, over the next few weeks. Here's our risk. Our risk is a move right now down to about 30.27, because remember, we can drop to 23% retracement from 0 in no time at all, as we saw right here. It can happen very, very quickly. This is just all noise. No significant resistance. Now, there's going to be a little bit of support right here at that 78% retracement of the drop that we have since gone. We had that little island reversal that couldn't stay, and then we were kind of flirting between the 78 and the 23% retracement. And then we finally broke back through the 78, and then we were able to stay up there and working our way up to the top. So that's quite the move to the upside. But if we do get a drop to the 23% retracement from here, remember that that's going to be a pretty significant drop below the 30-day moving average, about a 4%. I mean, that will be a intermediate pullback that we'll get. So, so as much as that is just noise, how easy it is for something like that to happen, and it can happen at any time. Again, keep in mind this gap is just so big because the rally has been so big and long here. But we can drop down that far that fast and really be nothing. And that's, you're looking at a move down here at about 30.27. That's about 250 point drop from where we're currently at. The question is, when will it do that? And we can still move the 0% line up higher with new highs even after this cluster, and bring the 23% line up closer to the 30-day moving average, depending upon how far and how fast we go. So just kind of keep that in mind. But the cluster really kind of stands out. And if you look at on a weekly chart, because again, you have, this is the end of a week on the S&P 500. You notice the intermediate line just barely crossed back above the market sentiment line there. So, again, crossing above the market sentiment for the, and producing kind of this dark green shading green line phenomenon can last for a while. So on the weekly charts, that's just started, but it doesn't mean that we can't come back down towards this 30-week moving average even after we get started here. So you can see the near term line, has been strongly bullish. So it's great. I mean, we're well established in here. The question is how much longer this weekly near-term run will last. You can see they tend to last quite a long time, multiple weeks, and we're just now, let's see, this one was just below it here. Let me see here. Yeah, that one's at 49, so we're just 4 weeks into this current near-term run. It's also the end of a month, so let's take a look at the monthly market forecast pattern for the S&P 500. And look at this. So its intermediate line is actually just barely turning back up with a strong near-term high point here, getting back up into the upper reversal zone, getting back above the market sentiment line. If you were to kind of zoom out here, so I can go out 20 years, again, this is about as low as the intermediate line got obviously since this time frame. In fact, you have to kind of really go back to see a time frame on the monthly where we turned up without on the monthly intermediate line without getting below 50. In fact, remember how 60 and 40 are really important levels on oscillators too. We have jumped back up above 60 and we're at 65 at the end of this month. Last month we were at 59, so we had dipped our toe underneath 60, which, remember, being above 60 is really bullish, strongly bullish. So that's really important. But if you notice, like the last time we had something like that was kind of like in the early 90s, where we had a little bit of dip to the moving average, light pink shading yellow line, and we bounced up. We had gotten down to 55 there, and then over here we got down to about 70, light pink shading but no yellow line. Remember here we got the light pink shading yellow line twice. This one got to about 73 and then now 55. So so there's precedent for these kind of short-term dips where we have, and this was the fourth quarter of 2018 that was so bad. Those two of those 3 months. Then of course the first quarter of this year with February and March. By the end of March we were already rallying off that long upper shadow. So a really good quarter this quarter. And then, of course, back here, we had 3 months in a row, December, January, January and February of 2016, that we came off those lows in both those months and then rallied up higher, getting a cluster right out the beginning and getting a cluster right out the beginning over here as well, before we pull back down, in this case, to the 30-month moving average. We had multiple months of weakness in 2011 that culminated with the credit crisis in August and September of 2011 that we since popped back up. So, so we got the near-term pullback here, and now again we are, this was below 50, so we are 1, 2, 3 months into this current near-term run that typically can last months. Doesn't mean that we can't have a dip a month or two here or there, but you can see how on this long, as bullish as we are on the daily charts here, on the long-term charts, in the weekly and the monthly, we're kind of just getting started on these bullish runs, these bullish intermediate runs. Not so much on the monthly, but on the weekly we're kind of getting started. On the monthly, we're getting started on this next leg of the monthly intermediate run that's been going on, obviously, all the way since the 2009 low point that we formed. Really quick glance at how these others are doing. You can see the Dow's not nearly as bullish. In fact, the intermediate line has fallen back down below the market sentiment line, and they're both falling. So that's kind of an interesting development on the Dow. Keep in mind the Dow is going to really be altered significantly when Apple splits its price 4 times. The NASDAQ 100, really close to a cluster. The intermediate line's turning back up, still below its market sentiment though. But a very strong short-term sentiment that we haven't had for a while. And then you can see here on the Russell, we're just not able to really get going. The market sentiment, the intermediate line strongly bullish, but we're not really getting good, strong near-term runs up to higher highs, and we're kind of stuck in between the 0 and 23% level as well, and not, you know, not being able to get above the 78% line like we have obviously on the Nasdaq back in May. Oops, sorry, and like we did on the Dow Jones Industrial Average. We've been kind of flirting with that 78% level as well, and then of course the S&P, we flirted with it before and then got back up above it there. So, you know, that's a big thing we need to see to really like maintain bullishness, as to get above these 78% lines on the Dow and the Russell too, especially the Russell. And we haven't seen that yet, so don't really put all of our eggs in that bullish basket from today going forward. Because of that, these can act as some resistance levels and might slow us down from everything else getting going, especially with how extreme this QQQ to IWM ratio with today's move especially has become. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this, the icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another one on Monday. You know, if you like our videos and you want to let us know, you can do that with one click right now by hitting that thumbs up. If you don't like our videos, of course, you don't have to click on anything. Also, too, comment. What did you get out? What questions or comments do you have about anything I talked about in the video today? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content at DavidSettle42. There's my handle up there. I post content from day to day in between these videos. And then join our Market Outlook Facebook group that we've created. Alright, so if you're watching us on our website here, you can check out some other of these links that we have. There's some recent posts over here, as well as our Market Outlook Live. Every day I do the Market Outlook. I also do a live video on YouTube at 3:30 Eastern Time. I review all the old trade ideas. I put on today's trade idea before the market closes. So you want to check that out there, as well as all of our upcoming classes you can see on our Trading Rooms page right there. All of our monthly subscribers, our plus subscribers, get access to our live video, Market Outlook live video, and all of our Trading Rooms. Our premium subscribers get access to all that too. In addition, they get access to our Q&A sessions. I have one tomorrow morning with all of our premium subscribers, a group Q&A session. Also, they get access to all of our premium tools, charts, custom content, as well as access to our community, including our class forums that we have. One more thing here, click on this heart. That opens up this new window. Hit that like button right there. Also hit the thumbs up icon here. That takes you to your Facebook, to the Market Outlook Facebook page. Hit that like button right there. That benefits us, because the more likes these posts have, the more Facebook and Twitter will promote our content to all of our followers, even if they're not looking at their accounts at the time we post these. It also benefits you, because these platforms will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. Alright, let's get back to the charts, and let's take a look at the long-term weekly chart here, and the Hakinyashi candle that we got. So the PPO is still rising really nicely. If you look at the Hakinyashi candle, we did not get a higher high, so not as bullish there. We did get a higher close, however, and we did avoid getting a lower shadow. So those are relatively bullish signs, 2 out of 3. You can see, you know, the open for next week's Hakinyashi candle is going to be right around this 32.17 area. It's the midpoint of this week's body, so that's going to be the open for next week. So right around 32.20 in that spot, give or take a few points. Right now we're at 32.71. The high this week is at 32.72, so we're right at the high. So we're gonna have a little, we're gonna have a small body depending upon how we open Monday morning. We're most likely gonna have a small body here, and a really good chance to get a higher, high on this. But also keep in mind You know, you get the idea. Like this week's range was 68 points, so we can also go down. I mean, we would only be about 50 points from the open. So there's a good chance. I mean, as in this, you know, this range was 110. There was 70. That one was 166. So if we get a decent range in a week, we could not only get a higher high, but we could also get a lower shadow, which is, you know, signs of, you know, like we saw on the NASDAQ a couple of weeks ago, a potential reversal. So and the NASDAQ has gone 2 weeks in a row with getting lower highs and smaller candles and smaller bodies. And we did finish, like the high here, 10,908. We're at 10,905. So again, we're going to have a little bit of a bullish body here. The question is going to be, you know, whether or not we get another, again, any kind of bearish move, significant bearish move next week will really set us up for this type of reversal pattern. Otherwise, if we stay up and we form a higher high and we bring the Heikin Average close up again, like we did here this week on the NASDAQ, then that will be a good sign. You know, you notice we didn't quite do that on the Russell. I mean, we're not getting broad strength. It's pretty well right now confined to the biggest companies that are out there. The ones that posted their earnings after hours yesterday, their strength continues to kind of bring everybody up associated with them or in that space, bring, you know, this work from home space especially, bring them up with them. All right, if you take a look at the 3 green arrow chart, let's take a look at 3 green arrows here. And you notice, sorry about that, you notice that we are back to, we had 2 red arrows briefly, we are back to 2 out of 3 green arrows. But keep in mind that that might be temporary. The stochastics, excuse me, sorry. Let's look at SPY here. The stochastics is back above its moving average. It has turned back up. The MACD is not back above its moving average. And, you know, we're showing a positive turn on the histogram. We might get a green arrow here pretty soon. But keep in mind, their averages are already pretty high. So it's not like we're going to start to really bring them up. So we're not, more than likely, we're not going to get significant moves here away from these moving averages. For example, you know, how far away are we from the 30-day moving average right now? Well, if you take a look, we are about, you know, just about 3%. So, you know, that's not a super high move, but it's gonna, you know, the super high moves are over here, and now we just kind of grind. You know, these line levels kind of come back down before eventually we get below the moving average. This one we only got below by about a 1.5%, a little less than 1.5%. That led to a good bounce up. Again, if we get below that 30-day moving average down to the 23% retracement, then it's going to be, you know, more significant. Something, you know, not necessarily causing that kind of decline, but at least, you know, again, where the intermediate line on the market forecast turns down for a while, and eventually we get a red line and dark pink shadings. We might not drop very much, but that's the kind of move that we could probably expect if we stay limited to this 23% retracement. Otherwise, the kind of move you'd expect would be like this one. This one got down to the 23% retracement, got significantly below the 30-day moving average, made a run back up off of it, but stayed bearish, dark pink shading in a red line, and then we rolled back. Then we did break eventually, and that was coming off the major low point, a big long run, very similar to this. So that's the kind of move we might expect to see, where the break to the 23% starts it, and then we stay there for a while, and then, you know, at the very end of it, we might get a break down to the 38%. Probably this area. I would say down to 29.40. There's going to be some significant support in this spot. That's probably as far down as we'll go before we bounce back up into a new intermediate run afterwards. All right, now let's take a look at the intraday chart here, and you can see the nice rally. That's why we got the cluster, is that big rally at the end of the day, at the end of the week. Did not get a new 4-week high point, so it's still, you know, we still don't have a new high tag over here, and you can see the low tag is pushing further and further over to the right as well. We have, you know, after this, after a couple of weeks, about a week and a half, it's going to really move up. The low is going to move up into this zone. So we kind of have this upper half of the S&P's 4-week range, and what that looks like on a daily chart is this here. Let's just pull it up right here. You know, you have this kind of upper half of the range right there. Here, let me zoom out. There we go. Right there, the upper half of the range. So getting below that would be below the moving average. So that would be getting into, you know, 317, getting down to this 313.69 level. So let me show you where that's at on SPY here. So that would be getting down, sorry, wrong one, this one. Let me look at SPY. So that would be getting down to here. See, there's 313, 311 in this area. So breaking through that 4-week range into this zone, to the bottom end of the 4-week zone, you know, that would be breaking below. Now, either we hold that 78% and we stay bullish, right? And we just kind of continue to grind if we even get down there. And you can see it'd be very minor drop, similar to that one. Probably get some light pink shading, maybe. You get a yellow line if we close below it. And then either we pop and like this and we get a new leg higher, however long it takes, before we finally kind of pull back into this zone. Or we break. And then that's what will cause a 23% retracement. And again, coming down to this level is going to start an intermediate pullback, right? Where we get an extended period of dark pink shading and a red line, even if we don't necessarily, you know, we're so conditioned to, like, when the markets are bullish, they go up every day. When the markets are bearish, they drop 30% in 4 weeks, because that's recency bias, right? But the reality is, you know, usually we drop right off the bat, and then we just kind of hammer around here, and maybe go a leg lower at the very end, with some kind of bullish divergence into like a support area. So that's most likely going to be the case. We'll get a drop, and then we'll just kind of go up and down between the, probably go back up and down between this 23% retracement and 78, which will still all be below the moving average as it rolls over, until finally we kind of make one last push to support and then a bounce off of that, which would not be that big of a deal in the least bit. If you take a look at the volume and the trading range, today's volume was the most. So coming off of this earnings, we had above average volume. We did not have that big of a range, a little bit above the average, but that average has gotten so low. You can see the, you know, we're still at 4 points. So, you know, we're still at this 1.5% mark. We're not really established in this grinding bullish trend until we're below 1%, and that's 3.26. That's where the ATR has got to get to 3.26, which means we got to continue to get days where we're below this ATR, and that wasn't the case today. And volume is relatively low, and you would expect that it would continue to grind lower as we push up higher. What we're not seeing necessarily is a big drop in volatility. On an absolute basis, we're still in the 20s. We're still, you know, low 20s, but we're still above 20. But you notice we are extremely low on a relative basis. So the VIX has gotten down here to this 80% mark, which is an extreme low. And we're getting, you know, we had a relatively big range the last couple of days, but I would expect some smaller ranges now that we're through the bulk of earnings on the big dogs that are out there. And that could very well lead to a pop in volatility. Again, not a big pop, one that would be associated with a 23% retracement. And it would probably at most get us up to this 100% mark, maybe up to 105, and that would be it. And that would coincide with an intermediate pullback and nothing more than that. So, you know, that's coming. We don't know the day when that comes. It's like a tornado. You know, you can see the storm clouds forming, but, you know, shoot, as we know here in Utah, we can get storm clouds and not a single drop of rain. It'll just go right by. So, you know, storm clouds may be forming in the form of really low volatility, but the pop, the tornado, the big storm, you know, doesn't have to necessarily come to fruition. But we know they come out of these types of storm clouds. So the more, you know, the more we get these scenarios, the more likely we are to get a pop. Which, you know, because we've gone down so low, now will not be that big of a deal. You pop off a 90% up to you know, through 105, and now we're looking at maybe a market sentiment pullback if we get up to say 115%, or 125% leads us to a death cross expectation. So that's, you know, we've gone so low that, like I said, I think at worst we get up to around 100% and maybe a little bit above it, and that's it, because volatility has gotten so bullish. So to summarize our technical outlook before we look at some other things here, we obviously have been in the bullish trend, but this little overbought cluster is this a red flag. It doesn't necessarily mean that we're going to tank tomorrow or Monday. It doesn't necessarily mean that we're going to fall off a cliff, but it does mean at the best that we need to really start reducing and being aware of reward risk ratios profiles on any new bullish directional trades, and stick to more kind of neutral trades with the idea that we're closer to a retracement than we are further, as indicated by this cluster signal on the market forecast. So what do you think? Do you agree with that technical outlook? Do you disagree? Let me know in the comment section below, especially if you disagree, and share with me what you see that either makes you a lot more bullish than I am or a lot more bearish than I am. And share that chart or indicator, whatever you're seeing, with our community down below. All right, let's take a look at the dollar, and that's been a big driver, and let's look at it with the euro here together. That's the biggest currency, and you can see we hit the 62% retracement level of this big dollar rally, euro decline that we've had over the past couple of years. So once we really started to drop, and after that first quarter of 2018 where the dollar took off, since then it's been on a steady decline. A little bit of a jump here, obviously a bigger jump on the COVID, but now we've had the biggest move through the retracement zone up to the top of the retracement zone. And we talked Wednesday about how far above the 30-day moving average we are at. That remains to be the case, even though we're coming back now. A little bit of, as much of an engulfing pattern as you can get, with the currency. These are 24 hours traded, so you usually don't get the clusters. We also came pretty darn close to a cluster here, with just lacking the momentum line, getting up to strong levels because of the up and down, with the lower shadow yesterday. But a big upper shadow, and upper shadows tend to be bearish at the end of bullish moves. So what does that mean? Well, that means that there's an expectation that we can get some weakness in the dollar in the near term. Even just a retracement move. We've been on this bullish intermediate run since down here. So if I were to draw retracement zones, you can see even just to come down to the 23% retracement wouldn't be that big of a deal in terms of this Fibonacci retracement zone. We'd still be in the upper half of the zone. More than likely, we'd probably come down towards just 38% retracement, considering how bullish we've been, and get a little bit of an intermediate pullback itself on this. And again, that would be bullish for the dollar, but it definitely wouldn't be trend changing bullish. It seems like we've really kind of altered the trend for the currency on a long-term basis, to where we are now headed lower for the dollar and higher for the euro. One thing that we're still not seeing necessarily, and that's kind of falling with the dollar lately, is yields. Yields have been extremely low, but you can see that we've got an oversold cluster again. We got a bunch of oversold clusters when this COVID very first started, initially when it was hitting in China, and then now the big drops down here in yields, and we kind of stayed down, retested those lows for a while and stayed bearish. We've got another kind of set of oversold clusters again. If you take a look at it on a weekly chart, you notice we got a cluster on the weekly chart. And then if you take a look at the monthly chart, let's go to a 10-year monthly chart, we got a cluster on the monthly chart. So we got a cluster on the 10-year yield on the daily, weekly, and monthly chart all at the same time. Now you notice we've been getting out of the last 1, 2, 3, 4, 5, 6 months, we've had 4 clusters. So it's been a move for the yield, and we are well below. You look at even the weekly, we're still well below the moving average, 30-week moving average. We're obviously well below the 30-day moving average. Not as big of a discrepancy, but we're pretty bearish, and this is about let's see, we closed at 536 yesterday. We closed at 541. The lowest close over here was 571. So aside from this one crazy low where we got below 0.5% briefly, there, one bare close before we popped back up to all the way up to 75. We went from 50 basis points to 75 basis points, just like that. Got all the way up to over 125 basis points. on that first initial rally off those March lows. But you can see, this, aside from that, this is the lowest close on a daily, and of course on a weekly basis too. This is the lowest close on a weekly basis because we didn't close that week down there. So very, very significant. And again, that's a good sign. When bonds being as overbought as they are, as yields rally, bonds fall, and that's typical of risk on moves. So that's why, again, we are hardly like extremely overbought in terms of risk appetite as a whole. We're pretty overbought in terms of equities, especially in the intermediate term, but we're not really even overbought in equities in terms of long term. These safety asset classes, including gold, have been so bullish. Look at the cluster we're getting on gold on the weekly chart. Let me go to a daily chart so you can see it. So how bullish and how far away from the 30-day moving average we are there. Let me kind of give you an idea the extent of how far away we are on gold above its moving average. So let me switch this one, whoops, and then 30, and then we'll go to simple. So here we are down there. We're pretty far up on the daily chart. Let me give you some context, say like the last 10 years. And, here we are, 7.75. That is one of the highest levels we've been, right there in 2016 we got up above 10%. And over here during the credit crisis, we got up over 10%. Other than that, this is pretty high from where we are. And, typically leads to at least a slowdown like it did over here. It led to at least a slowdown, and then eventually on the second wave to a bearish divergent high point and then a intermediate pullback there. So needless to say, there's a good chance that that gold's going to pull back. There's a good chance that the dollar rallies. You can also see too. Let's see, that was on the daily chart. The weekly chart, I wanted to show you the monthly chart too for gold. And you see how, here, let me get rid of this down here. You can see how close we came to a cluster on gold as well. Now, we haven't been as bullish for as long, and if I were to zoom out so you can see even further on this, you can see, kind of the breakout that we're getting here this month. We've had a breakout, and that's a pretty big cup here. With a move, down to 1050, with up here being about 1830 roughly. So you're looking at about 825 points to the upside. So you're looking at about 2600. And I showed you on Wednesday, gold might be really like high here, but it's still really low compared to equities, which means again that the dollar's got a long ways to drop, a long ways to drop. It's a good sign for risk appetite when it does that. Let's take a look at crude oil prices, and you can see, or let's look at commodities in general. This actually will include some gold in it, but you can see the bounce, and we're finally recovering off of some significant low points. We are at an area though where that's a bearish pattern on the weekly chart. This is what it looks like on the daily chart. Here, let me get to the Bollinger Bands so you can see what we look like here. We're kind of at the top of this. So a breakout, great. But, resistance in this area, and we might get a little bit, back down. Now, we are in the value area, so we have a draw up to that point of control. That point of control is going to change, as time passes and we get some of these prices come off. Your point of control is going to change a little bit, and so the value area is going to change a little bit. And so it's going to kind of fluctuate in this area, but still in the higher end, which means we're going to be drawn up here through that. But, that might, on any intermediate pullback, you would expect this to pull back. So if we're hitting resistance, and don't be surprised if we come back down and test in this area, which would coincide with everything else we talk about. But a breakout through there, and man, that's bullish, and that's going to be bullish, like I said, for risk appetite as a whole, more than likely. All right, now let's take a look at how the sectors performed here this week. And you can see the big gainer, and it's really coming off of remember those FANG stocks, including Microsoft, they make up about 50% almost of the Nasdaq 100. So they're even a bigger influence in that space. Remember, they're also spread out too across XLY and XLC. It's not just XLK like it had been in the past. But if you take a look at this week, I mean, it is XLK. That's Apple, right, and Microsoft that's up in there, and of course you have Facebook and Google and XLC, and you have Amazon and XLY. But aside from real estate, which kind of had its own move, everything else really up sharply. Utilities also staying up here with yields falling very low. That's making dividend yields in a lot of these areas very attractive. It's making equities very attractive, and the bullish dollar, interestingly enough, by the end of the week, as bearish as the dollar was all week long until the end of the week, you can see the pressure it put on these dollar-sensitive areas: industrials, materials, energy. They've got some room to run, but they're not the leadership right now, and the market's not favoring them. They're still big decliners. Materials is trying to make a decent run, but they're all big laggards, and our big winners continue to be these tech space areas. And as long as we're pulling forward a lot of this work from home and 5G, all these things that we've been kind of trending towards, but it's been accelerated with the COVID disease and the coronavirus, that is, it's making the leadership kind of hard to change, to rotate out of. As much as, every time it pulls back, we talk about the great rotation that's occurring, but the reality is it's just the pullbacks, right? It's just exhales, but the leadership remains intact, and there's strong momentum in that leadership, and we would expect that leadership to continue to be the case going forward from here. One area of the market that fluctuates from leadership to not is the healthcare sector, and one stock in that area that kind of looks pretty bearish here coming out off of its earnings is AbbVie. You can see it's got dark pink shading and a red line, and it's we were just barely below, and you had a really good bullish kind of buy the dip pattern here, light pink shading and yellow line, but we dropped deeper. We've got now dark pink shading, and now we have a red line. Intermediate lines falling into the reversal zone. You can see other patterns. We did get a little bit of a bounce into the very end of the day, but you can see how we're close to breaking below 40. We're dropping down to this, well below minus 100 on this. You look at the DMI chart for it, and you can see we popped up above 25. We're well below 20 on the positive index, popping up above 25, which is always a bearish thing when you get below 20 on this. The positive directional index gets below 20. Let's look at its Bollinger Bands, and you can see that we're pushing that lower band down. We were down actually a little bit below it at the low of the day today. We're a little bit below it, and you can see again we're in the value area, so we've got a pull down to this point of control. So it's not necessarily the most bearish chart, but we know there's opportunities for an exhale here. That seems like we're starting with some of the patterns we're seeing on the chart. Here's the 3 green arrows that we've got, and you can see both the 8 and 17-day moving averages have crossed below the 30-day moving average. That's how bearish we've gotten. Stochastics is in the lower reversal zone. MACD, the moving average for the MACD is crossing below 0. Stochastics is the moving average for the stochastic is crossed below 40. So I mean we haven't had that for a while. So there's a good chance that this turns into something more than just something more than just a little down by the dip. We can be down, might not go down very far, but we can be down for a while, and that leads us to saying, okay, well, let's take a look at selling a bear call spread. It's got relatively wide spreads, but if we take a look at a bear call spread for this and sell the 98, 96 here, let me bring it up here. There we go. We sold the 96 strike and bought the 98. I believe we did that. We got, what is that? 68 cents out of it. So we just had earnings. We don't have to worry about position sizing for earnings. So we position size for normal risk, trying to shoot for $476 on a normal risk. And then again, that's how much I'd be willing to lose. I don't want to lose 924 bucks if it goes against me. But if I lose more than 476, I'm out of the trade. And so you can see I'm down just a little bit here. But as long as we stay below this area, below that moving average, below the 8-day moving average, which you've been below for a while, below the 17-day moving, as long as we ride these down and stay down, then I don't care what it does, right? Time value will eventually bring this purple line up. Time decay, excuse me, will bring this purple line up to the green line at expiration. So that's how that trade is set up. Alright, so that does it for tonight. You've heard from me now I want to hear from you. Use that link that takes you to our Market Outlook forums on our website at marketscholars.com. Open any new thread with any questions or comments you have about what we talked about in the video today. Reply to other people's threads, and let's keep this conversation going here with our discussion, our Market Outlook discussion. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video. Follow me on Twitter for more content between the videos. Join our community with that link I showed you before at marketscholars.com for free, as well as our Market Outlook Facebook group that we've created. Have a great rest of your Friday and your weekend, everybody, and we'll see you all on Monday.